One of the things we all have as investors is bias. And bias may not be a bad thing because it does allow us to filter out companies that don't fit within our investing strategies. And that's very important because there's over 2,000 companies on the ASX. So there's no way we are able and capable to research every single company on the ASX, let alone on international exchanges. And having biases helps us to do that. But sometimes we can have general bias. For instance, I have a bias against ASX 100 companies. As soon as you say a company is in the ASX 100, my immediate thought goes to it's just an income company. And the only sort of investors who would put their money into those sort of companies just want the dividend. And the sort of companies I am looking for are growth companies. I want companies that are going to be significantly bigger in 5 to 10 years down the road. And in ASX 100 companies, in the most part, don't fit within that investing strategy. But I want to test that bias I have against ASX 100 companies. Does it hold true for the majority of companies? Or are there companies within the ASX 100 that are investable companies according to my investing strategies? And am I missing out on real good opportunity in investing in high quality growth companies? So I chose 10 random companies in the ASX 100 to test my bias. And it really opened my eyes up to that lost or potential lost opportunity that there are some really good companies in the ASX 100. And because I really like doing that video series, I've just decided to broaden the scope of companies that I'm willing to look at. And instead of looking at the ASX 100, I'm going to be looking at 10 random companies on the ASX 200. And I chose 10 random companies. I've already done a video on the first 5 companies. And looking at those first 5 companies, again, opened my eyes up to the possibility that I am missing out on opportunities. But the thing that really opened up my eyes on when I looked at those first 5 companies was I do have individual or biases against individual companies, but I also have biases against individual sectors, like the property sector. Immediately when you talk about companies that are in property, I think, yeah, they won't be growing all that much over the next 5 to 10 years. They're just there for the income. The only sort of investors that will put their money into property companies just want a dividend every 6 months. But one of the companies I did look at was Aventus Group. And Aventus Group has been growing at a good rate over the last 5 to 6 years. And that just made me realize that potentially doing more research on property companies could be a good idea in the future. And among those first group of 5 companies I did look at in part 1, the majority of my biases did hold true. And those companies were Breville, IPH, Woodside, the Star Entertainment Group, and the aforementioned Aventus Group. I didn't know anything about Aventus Group, so doing a little bit of research on that company opened my eyes up a fair bit. I've always known Breville as a high quality company that is gaining traction around the world, and the only question about Breville is the valuation. And I do think coming away from doing a little bit of research on that company, that still holds true. IPH Group is a slowly growing company, and if they can increase their margins, they could become an investable company in the future. But when we talk about the Star and Woodside, both of those companies are definitely not investable companies. They are not growth companies. And the only time I would consider investing in those 2 companies is for a short-term value play. At this point in time, that value play is just not there. The 5 companies I'll be looking at in this video include Perseus Mining, which is a gold company. And to be honest with you, I have done no research on Perseus Mining. And when I did a little bit of research in preparation for this video, it was intriguing. So Perseus is an intriguing company. JB Hi-Fi, in my opinion, is the best quality retail company on the ASX, and that hasn't changed for the past 5 to 8 years. Platinum Asset Management, no research for that company. I'm not that interested in fund managers, but doing a little bit of research in preparation for this video, this company has become a little bit more interesting and may not be the reason you would be thinking about. SEK, is a growth company. And again, just like Breville, it's just the valuation. I have a question about that company. And even though it is a growth company, I think the growth of SEK is probably not to the point where I want it to be for an investable company. And the final company is Orica. I know nothing about Orica. They're into mining services, if I remember correctly. And as I looked at the financial state and financial performance over the past 10 years, there's no reason to do any more research on that company. I'll talk about that when we get to the Orica part of this video. But the first company I'll be looking at in this video is Perseus. Perseus is a gold mining company. And what I'm going to do is look at or compare the financial performance of all companies for the last financial year and compare it to the financial performance of the company 10 years ago or whenever they listed on the ASX. For Perseus, that's 9 years ago because they went to production during 2011. So if you look at 2011 numbers, you'll get a lot of zeros. First thing I'm always going to look at is the market cap. Has the company grown over the past 10 or 9 years for Perseus? And it has grown for Perseus. In fact, the market cap or valuation has increased from 1.1 billion to 2.1 billion. This company is a growth company, just looking at those two numbers. However, in saying that, the path for Perseus hasn't been a straight line from 1.1 billion to 2.1 billion. In fact, the market cap of Perseus in 2015-16 was around or just under $200 million. And you'll be able to see that when we look at the chart for the company. The other thing you have to take into account for Perseus is the amount of shares on issue have tripled over the past 9 years, increasing from 450 million to 1.2 billion. So even though the market cap or the valuation of the company has almost doubled, the share price actually decreased over the past 9 years. Now let's get to the financial performance of this company, and all the numbers are up since 2012. Revenues increased from 145 to 680 million. Profits increased from 47 million to 116 million. And operating cash flows increased from 43 million to 302 million. So if you do compare the financial performance of Perseus from 2012 to 2021, things are going or moving in the right direction. They have net cash of 50 million. So everything's looking good for Perseus. Everything is telling me this is a growth company. The other thing I do like to look at is comparing the valuation metrics compared to the historical range or what we should expect from this company. So for instance, price to operating cash flow right now is at 7, and historically you expect a price to operating cash flow for Perseus to be between 4 and 8 roughly, not always, but roughly. PE ratio currently is 18.1. Historically expect Perseus PE ratio to be in the teens, and the price to book ratio right now is 2.04, and historically that's less than 1. Looking at the valuation metrics right now for Perseus, it's telling me there's no value right now for this company compared to where you typically see on historical ranges. So no value play here for Perseus. One of the flaws I do have in just comparing current financial year numbers to 2011 or 2012 numbers is you miss what happens in between those 2 years or the last 10 years. So even though the valuation of Perseus has climbed from 1.1 billion to 2.1 billion, it hasn't been a straight line. We have seen the market cap of this company fall as low as 200 million. You can see that in the chart right here. This is the weekly chart going back to 2011. And back then in 2011, the share price of Perseus was in the $3 to $4 range. But during 2012 and 2013, the share price fell quite significantly from that $3 to $4 range all the way to a low of 25 cents. I'm not sure what happened in that period, why there was negative sentiment. Maybe it had to do with the gold prices, or maybe it had something to do with the business. And remember, Perseus Mining went into production in 2012, and that's why I'm using 2012 numbers, not 2021 numbers, looking at their financials. But we saw a 5-year consolidation period for their share price. That's a long period of time if you were a shareholder waiting patiently for the share price to break out. And the share price eventually broke out in the middle of 2019. And ever since that breakout in the share price 2 years ago, just over 2 years ago, we've just seen the share price go up. And right now, the share price is $1.77, which is an 8-year high. And the really interesting thing about Perseus is it's not really, the share price of Perseus is not really correlated to the gold prices. So a lot of other gold companies' share price has been affected by gold prices over the past year, but Perseus' share price keeps on rising. So there's a lot of interest in the market around Perseus. Potentially, Perseus have something in the pipeline, maybe some new projects that the market are really keen on, really excited about, and that's why the share price keeps on increasing. And I do find it attractive to, discover a commodity company, a commodity-driven company whose share price is moving in the opposite direction to the commodity prices and other companies within this area. And that's exactly what Perseus has been doing over the past year or so. So this company is looking quite intriguing right now. Share price is at an 8-year high. Share price is moving in the right direction. Positive sentiment behind this company. Things are looking good for Perseus. I'm going to have to take a closer look at this company, I think. On to JB Hi-Fi. In my mind, this is the best quality retail company on the ASX. Every single time I go into one of their stores or walk past one of their stores, there are a lot of customers, a lot of clients in the store. So that's something management have done very well over the past 10 years is just whatever strategies they have employed, it's been successful in bringing in the customers. Now, over the past 10 years, this company has grown quite considerably. They have also bought the Good Guys, was that about 3 or 4 years ago? And that has also helped with their financial state. But the market cap has increased from 1.7 billion to 5.8 billion. That's a 3.5 fold increase in a 10-year period. Shares on issue have remained fairly level, increased slightly from 109 million to 115 million. So it hasn't been much dilution for shareholders over the past 10 years. Revenue increased from 2.9 billion to 8.9 billion. Profits increased from 110 to 506. Operating cash flow increased from 110 to 559. It's really interesting when you look at revenue, profit, and operating cash flow growth over the past 10 years. You could say it's increased by almost 5-fold or between 4 and 5-fold when the valuation has only increased by 3.5-fold. So that's telling me straight away that there has been more financial expansion with this company than multiple expansion. That means the PE ratio hasn't really increased over 10 years. That also means right now you don't have to pay a premium for JB Hi-Fi compared to 10 years ago. But on the flip side, it could also mean that financial year 2021 was really good for this company because of COVID-19. And we're going to see some of these financials, the profit, revenue, operating cash flow for in financial year 22. So it'll be really interesting to see how a lot of retail companies perform for this current financial year. And I do think the market is expecting a lot of these numbers, not only for JB Hi-Fi, but a lot of other retail companies to fall, and that's why you are seeing some fairly low valuations for these companies right now. Net cash of 260 million, and that does not include leases of 620 million because this company probably rents out a lot of its stores, and so they probably have a lot of leases. Now, again, back to the valuation metrics. Some of these look quite small. For instance, price operating cash flow at 10.4, that's within its historical range, which is between 8 and 12. But the P ratio, 11.5, it's on the low end of its historical range. That does seem quite small for a company that has been growing over the past 10 years. But again, I do think the market expects profit to fall in financial year 22. And price to book ratio, 4.5, historically between 3 and 6. So just looking at the valuation metrics, they do look fairly low, but I think the market is pricing in some decreases in some of the financials for the next financial year. If we don't see profit falling, operating cash flow falling, revenue even falling, then right now could be a good time to buy JB Hi-Fi. One thing I like to do for these growth companies that have seen some good growth over the past 10 years is just to figure out whether the valuation, share price growth, is attributable to financial expansion or multiple expansion. An easy way to see that or determine that is just to look at the P/E ratio, price to sales ratio, price to operating cash flow over the past 10 years. And if it's climbed or if it's higher now, that means there's been some multiple expansion. But with JB Hi-Fi, if we look at the revenue, operating cash flow, and profit compound annual growth rate of all the three of those financial metrics, and then compared to the market cap and share price growth, we can determine if there's been any financial or any multiple expansion happening. If the market cap and share price have been growing at a lower rate than revenue, operating cash flow, and profit, there's been no multiple expansion happening. And that actually would be an attractive company to buy into on valuation grounds. And this is true for JB Hi-Fi, not only over the past 10 years, but also if you look at the growth rates of those five in the past 5 years. For example, revenue over the past 10 years has grown at 12%, operating cash flow at 18%, and profit at 17% per year. But market cap has only grown at 13% per year, and share price has only grown at 12% per year, which is lower than operating cash flow and profit. And I think one of the reasons behind that is simply because the market is expecting operating cash flow and profit, maybe even revenue, to drop for financial year 2022. And that's why there does look to be some good value with this company right now. And that's also true when you compare revenue, operating cash flow, and profit growth over the past 5 years. It is higher than the market cap and share price growth over that same period. So just be aware that I do think the market is pricing in lower financial performance for this company in financial year 22, and that probably rings true for a lot of retail companies on the ASX right now. So don't be fooled by low valuation metrics for these companies. As we turn our attention to the weekly chart for JB Hi-Fi, this is exactly the sort of chart you want to see for a long-term buy. And if any shareholders have held onto their JB Hi-Fi shares over the past 10 years, more than likely that'll be very happy. And even though they probably would be happy, there would have been times during this period where they might have been a little bit stressed out, particularly during 2012 when the share price fell from $16 all the way to $8. So share price halved in about 1 year time span. And the reason the share price fell during that period was because of the threat of Amazon. Well, the perceived threat of Amazon. This was the most shorted stock on the ASX. And just after that, when we saw the share price fell to a low of $8, that's when I took a position. I completely ignored the shorting, completely ignored that perceived threat of Amazon because I thought it would be a while. And again, every single time I went into a JB Hi-Fi shop, went past the shops full of customers. And I think that's one of the most important things to figure out for these retail companies. Are they maintaining their customer base? And JB Hi-Fi most definitely have done that over the past 10 years. I really got to congratulate management because whatever they've done has really worked. But generally, the share price has been increasing for this company during the past 10 years. It's increased from that low of $8 to a current share price of $50. You could say over the past, well, it's been over the past year, 15 months, share price has been quite volatile at around about the $48 to $50 range. It's been as high as $54, as low as $44. So it does look like it's in a trading range right now. So right now, I'd probably be fairly neutral in regards to this company. If I do see the share price pull back towards the 200-week moving average, which is just above $38, that could be a good position or good time to buy, because over the past 8 years, whenever the share price does go below that 200-week moving average, which has done it 3 times, it has recovered quite quickly. So that would be my definite buying price for JB Hi-Fi right now, $38. It might be about $40 in a few months because the share price, if it does pull back, that moving average would go up towards $40. So I'd say between $38 and $40 would be a good buying price. Right now, a good risk-free price for JB Hi-Fi. I don't expect the financial performance of this company to suffer all that much over the next 5 years. They definitely have found their niche And I do think they can continue to grow, even if the threat of Amazon, threat of online continues. And I do think, if I remember correctly, JBH have been increasing their online presence quite considerably over the last 5 years. Next company I'm going to talk about and look at is Platinum Asset Management, ticker code PTM. I'm not overly interested in these sort of companies. I do take a look at the valuation at times, but I have not done with Platinum Asset Management. I could not tell you what sort of companies they do invest in. So they are a fund manager. Now I do, in the back of my mind, I am thinking they are a value investor, which would mean they have probably struggled in performance over the past 10 years, maybe even 12 years. Now, companies like Magellan have seen their share price go through the roof over the past decade. And again, in the back of my mind, I have heard that Platinum Asset Management had that same sort of growth trajectory more than a decade ago. But I'm only interested to see how this company has performed in the last 10 years and to see if I need to do more research on this company. So let's see how Platinum Asset Management has performed over the past 10 years. The markup has dropped. That's the first bad sign. 10 years ago in 2011, the markup was 2.3 billion. Now it's 1.7 billion. Now that's not an overall bad sign, but it is a bad start. There's a possibility that Platinum Asset Management could be good value, particularly if some of the financials have increased over the past 10 years. So let's have a look at some of the financials. Now, shares on issue haven't changed that much, so there's been no dilution for shareholders. That's actually a tick. I don't like companies that dilute their shareholders too much. But when you look at revenue and profit, we have seen a little bit of growth over the past 10 years. Revenue's grown from 254 million to 269. Profit's grown from 150 million to 163 million. There is growth there, but not that much. And then look at the market cap, it's fallen. So there is potential value right now, just looking at the valuation and compare it to the financials. Now, operating cash flow has dropped from 152 million in 2011 to 141 million. Funds under management have increased by a fair bit, 15.5 billion to 21.6 billion. So there has been growth in funds under management over the past 10 years. That's looking at November 2011 numbers compared to November 2021 numbers. Now it comes interesting is when I look at the valuation metrics. And what I'm doing here is comparing the valuation metrics now to the historical range for this company. For instance, price operating cash flow, 12.1. Historically, for Platinum, it's between 15 and 20. That's interesting. P/E ratio right now is 10.4. Historically, for this company, it ranges between 14 and 20. Oh, that's interesting. Price to book ratio right now is 4.9. Historically, it should be between 8 and 11. Now, when I say historically, it doesn't mean over the past 10 years, it's always in that range. There is a bit of fluctuation there. But when you look at all three of those valuation metrics, it's lower than the historical range. That's telling me right now there is potential value for this company right now, and that makes this company a little bit more interesting. The only time I will buy the banks is when the valuation metrics are very similar to Platinum, when the valuation metrics are below the historical range. That's the only time I have bought the banks in recent times. And when I say recent times, I mean the past 10 years. The first thing I did with Platinum Asset Management is just look at some of the financials of the company compared to the market cap. And there was a little bit of interest because even though the market cap had dropped, the financials, particularly the profit and revenue, have slightly grown over the past 10 years, which is hinting there might be some value there. Just hinting, but we can confirm that potential value when we look at the valuation metrics. All three of them are below historical ranges. That is telling me that there is potential value. And what we have to figure out is whether this is a value trap or whether there is value with this company. And when we look at a 10-year weekly chart, the share price right now is at a 10-year low, and there is a potential triple bottom right now with the share price at $2 $2.97. We saw the share price reach about $3 twice during 2020, during the COVID-19 financial panic, and then towards the end of that year as well. And both times we saw the share price get $3. There was a nice rebound. In fact, the previous rebound in share price, we saw it go from $3 all the way to a high of $5 in about 4 or 5 months. But the amount of negative sentiment and negative momentum in the share price right now makes me a little bit wary. We have seen a share price fall really quickly from $5 to $3. And over the past 5 weeks, we have seen a share price fall from $3.50 to $2.97 on increased volume. And the thing I have to find out is why has there been an increase in volume, particularly in that first week, so about 5 weeks ago? Was there some negative news in regards to this company? And if we figure out why, if there's no reason, and we've just seen this increase in volume because the share price has moved to $3, and that's a good support level for this company, we might see a bit of a rebound in the share price. But in saying all that, this is definitely not a long-term buy. The only reason I would take a position in Platinum Asset Management would be a bit of a bounce, a bit of a short-term play, simply because the company's not growing. And you can see that with the financials. And so the only reason you would buy Platinum right now is just a short-term play on valuation grounds. Fourth company I want to look at is Orica. I have no idea what this company does. T code ORI. I think they're into mining services, something like that. And the reason I have no idea what this company does is the first thing I usually do when I research a company is just look at the financials. Financials this year, compare it to financials over the past 5-10 years. And if I see no growth, in fact, if I see financials going down through time, why should I do any more research on a company? Now, you might be screaming, well, it's all about the future. It's not about the past for a company. But the future or the past can tell you a lot about a company. And if a company can't grow, hasn't grown, then that's telling us that there's more likelihood in the future that a company will not grow, even if they're trying to bring in some growth strategies. So let's have a look at Orica and why. I have no idea what this company does because I did no more research after looking at the financial state. First bad thing is the market cap has decreased from $8.5 billion in 2011 to $6 billion right now. That's not a good start. Shares on issue have increased slightly from 358 million to 407 million, so they haven't diluted shareholders all that much. But when we look at revenue, profit, and operating cash flow, everything's fallen over the past 10 years. Revenues dropped from 6.2 billion to 5.2 billion. Profit has dropped from 642 million to negative 174 million, so weren't profitable in the previous financial year. But that could be just accounting stuff. It could be just one-offs, some abnormals. Operating cash flows dropped from 758 million to 619 million. Capital expenditures dropped from 663 million to 305 million. And they have net debt of 1.8 billion. That's another massive cross against this company. Now, is there potential there could be some good value here? Let's have a look at price to operating cash flow and price to book. Now, we can't look at P ratio because the company was not profitable in the previous year. Price to operating cash flow, 9.7, that's within its historical range, almost right in the middle, so no value just looking at that. Price to book at 2.1, again, right in the middle of its historical range. So just looking at the valuation metrics, nothing to get too excited right there, unlike Platinum, which there is some reasons to get excited. So just looking at the financial performance of this company and the valuation metrics, no reason to get excited about this company, no reason to take a position. This company is not growing. In fact, it's going the complete opposite way, and more likely because of the market cap falling, we'll see the share price to have fallen over the past 10 years. So let's have a look at the chart now. And I'm telling you right now, it's not going to be a very pretty chart at all. As we look at Orica's 10-year weekly chart, this is not the sort of company you want to own for the long term. Share price indeed has fallen from around about $25 to $30 all the way to a current share price of $15.46. We actually saw recently the share price get down to $11.50. We have seen a bit of a rebound in the share price, and that could be just a bounce because around about $11.50, $12 is the historical low for this company. We saw that share price reached back in 2016 twice, and then again a couple of times in the past year. So again, that could have been a good buy for valuation reasons. But because of this rebound in the share price from about $11.50 to $15.46, valuation metrics have increased. So you can just see sometimes you can get a bit of a bounce just because of valuation metrics. But right now, with the share price bouncing over the past 5 weeks, no reason to take a position in this company right now. There might be some investors getting excited because of the increase in share price, but it's really, I wouldn't say a dead cat bounce, but it's not a bounce you get too excited about. This company is definitely not a company you want to have in your long-term portfolio. Financials aren't increasing. This company is not growing. The only reason to buy this company would be because of valuation reasons, and because of this bounce in the last 5 weeks, that reason has been nullified. Final company we're going to discuss in this video is SEK. This is a company I have held in the past, and one of the reasons I've held SEK is because it is a growth company. But one of the reasons I did sell out of SEK was because I thought the growth in the company, in particular the financials, did not justify the valuation. In fact, I was concerned about the lack of growth at times in the financials. And then they decided to sell out of Xiaopin, their Chinese business. And one of the reasons I was fairly bullish on SEK was because of their Chinese business. Some of these numbers are going to be influenced because of that, what's the opposite of acquisition? That selling of the Xiaopin. And I'll talk about that when I get to some of these financial numbers. Anyway, the markup has increased from 2.2 billion to 12.5 billion. That's a good start for this company. Shares on issue haven't increased that much, currently at 353 million. Now, revenue, I've got here 1.6 billion for the last financial year. SEK do report 700 million or something like that because they sold out of Xiaopin. But I've included Xiaopin revenue in this because I just want to compare revenue for the last financial year compared to 2011, just to see how it has grown, even though they have sold out of that business, and it's quadrupled over a 10-year period. If you took away that Xiaopin revenue, it looks like revenue has only doubled, even less than doubled. Profit after tax at 752 million, increased from 98 million in 2011, but the profit in the last financial year included some abnormal items which increased the profit by 600 million. So if you take away those abnormal items, profit in the last financial year was only 141 million. Again, not that significant increase over the last 10-year period. So it's increased by 50%. Operating cash flow has more than tripled over the past 10 years, from 108 million to 347 million. Capital expenditure, the only reason I've included capital expenditure is because companies like SEK don't spend a lot of money on capital expenditure. They're not capital intensive businesses, and that's one of the reasons a lot of investors are attractive to these capital light businesses, because they don't spend a lot of money on capital expenditure. They had a bit of surprising, they had net debt of 700 million. I thought that would be more like net cash, but net debt 700 million. Now it comes to some of the valuation metrics. Price to operating cash flow at 36. Historically, that should be in the 20 range. Price to PE ratio 88.8. Now that's using the net profit after tax X abnormal items, 141 million. So if you actually take it from 752 million, the PE ratio is like 13 or 14, which looks really low, really attractive. A company that's growing like SEK is with a PE ratio of 14, that's cheap, really cheap. But again, you've got to take into account they had some abnormal items which increased the net profit after tax a little bit more than it should have been. In fact, quite a bit more than it should have been. Historically, the PE ratio should be in its 20s. Price to book ratio at 6.8. That's within historical rate. So right now, SEK doesn't look that attractive when you look at valuation metrics, which makes sense because we have seen share price really take off over the past few years, particularly after COVID-19. I do think there's a lot more premium in the share price of this company than there used to be. And that's one of the reasons I don't find SEK all that attractive right now, just based off valuation metrics, even though it is a growth company. Sometimes when you do find a good growth company, the best thing you can do is to buy some shares in that company and just hold. Don't sell, just hold for the long term. That's one thing I have come to understand over the past 12 years, ever since I started investing, that sometimes it's just best to be patient. Just best to just hold and buy and hold for the long term. Don't put too much thought into whether you need to sell because of valuation, because of any other reason, because you get a company like SEK where you see a share price growing from about, we'll say $5 or $6 all the way to a current share price of 35. That's a 6-fold increase in share price over a 10-year period. That's a good increase in share price. That's a good increase in valuation. And there's really been no reason to sell out this company during this period. Whenever the share price gets below the 200-week moving average, it's done it again 3 times in the past 6 years, and each time it gets below that moving average, the share price shoots up. So just like JBH, if I do see the share price move towards that moving average and below it, that could be a good value play, good time to buy this company. So SEK, in my opinion, could be, probably is a good time, a good long-term buy and hold, just based off this chart, based off its financial performance, based off of valuation metrics. And I think I could be wrong and my bias is misplaced when it comes to this company. And that's it for this video. In conclusion, whether my biases hold true or I might have to rethink my biases, let's go through each company again. Perseus Mining, a little bit surprised that we haven't seen Perseus Mining share price under pressure like other gold companies. So I think this demands closer inspection, demands more research. I still think JBH is the best quality retail company on the ASX. That has not changed at all. Platinum Asset Management, I do not think is a long-term buy, but it does look interesting for the short term. So a potential short-term value play. But the question is it a value trap? And that does demand a little bit more research. Orica, my opinion on that company has not changed at all. Definitely not a long-term buy and no valuation play right now. Maybe 5 weeks ago there was a valuation play, but not right now. And SEK, maybe some of my biases were wrong when it comes to that company. Maybe thinking that on valuation grounds that was not a buy could be wrong. So it's very interesting to see that my bias in SEK might be misplaced. And that's all I have for this video. 10 stocks to buy part 2, looking at 5 companies on the ASX 200. If you have any questions about these 5 companies or any other companies on the ASX, I'd love to hear your opinions, your thoughts, your questions. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need to seek financial advice, make sure you find someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.